Hi, it's Stuart. Today I want to talk about, can you afford to invest in property? Obviously, if we buy well, and we must buy well if we're investing in property, that is, it's all about capital growth rather than cash flow. So really what we want to do is buy a property that has the propensity to double in value every 10 to 12 years, which means if we buy a property for $1 million today, in 20 years time, it's going to be worth $4 million because it's doubled a couple of times. And in 30 years, it could be worth $8 million. Now, these numbers seem really difficult to get our heads around. But the reality is that that's what the market has done over a long period of time. So really that's where our return is going to come from, is that property doubling in value. And then hopefully if we keep it for 20 years, we've got $3 million of equity in that property. That's a whole of a lot more money than any sort of incremental cash flow will ever provide you. Obviously, you've got to pay tax on cash flow each year. So therefore we want to buy well, which means sometimes spending a little bit more to get a better quality property. I wanted to walk you through how I look at cash flow and affordability, and then share 4 cash flow strategies or tips on how to manage your investment property's cash flow. But of course, it's really important to never over borrow. So we've got to stay within our comfort level. We've got to be prudent and reasonable, but also at the same time, try and push ourselves to invest a little bit more sooner, because in the long run, we know that's what's going to drive investment returns. So let me take you through how I produce a kind of back of the envelope estimate of what a property will cost you. So let's use an example, $1 million property renting for $750 a week. So the first thing to work out is start with is our rental income. So that's 750 times 52 weeks a year gives us $390,000. So that's going to be our gross rent. The next thing to think about then is our expenses, and I typically use 30% of the rental amount. So in this case, it's $11,700. And then of course the interest in respect to a loan. Now if we're bought for $1 million, let's assume we've borrowed the full cost of that purchase, plus a little bit of a buffer and so forth. So just to be conservative, let's do our numbers, assuming we've borrowed $1.1 million in total, at a current interest rate around 6.6%. That's $72,600 worth of interest per annum. So really you look at the rent, less expenses, less interest, we're negative about $45,000. Now that's your before tax cash flow impact. But of course we know we can negatively gear that property, which means we save some money on tax. The way to work that out is multiply your before tax cash flow negative by your marginal tax rate. In this case, let's use 47%. So we reduce our taxes by $21,300, which means our after-tax cash flow, so this is a really holding cost of the property, is $24,000 a year. And that's how to work out, how much is going to cost me to hold an investment property that has these attributes. And so in this situation, it's going to cost me $2,000 a year. Now, of course, I need to make sure that I can afford that, that I've got enough surplus cash flow to afford that. Now, let me share 4 cash flow tips with you. The first one is that the tax benefits associated with negative gearing are substantial. So in this situation, it's over $21,000 a year. You've got 2 options. You can either wait until the end of the financial year when you lodge your tax return and get a big refund, $21,000, or to help you with cash flow, particularly in higher interest rate settings, you can do what's called a PAYG variation, which means that you go to your accountant and they lodge a form with the ATO. The ATO then tells your employer to subtract less tax from your salary each month, thereby giving you more cash flow to sort of hold the investment property. If you're self-employed, you can vary your PAYG instalments, or your accountant can obviously do that, just again to take account of the fact that you're going to have these tax deductions, $45,000 of tax deductions, which means you're going to pay less tax this year. So PAYG variation is a really good thing to do, again, in a high interest rate environment, even more important. I like to invest first and spend what's left over. That means what I do is I work out what an investment property is going to cost me. So using the numbers that I just provided you, it's $2,000 a month. And then what I will do is set up a transfer from my bank account that receives my income into the offset account that pays for the loan repayments. And so I'll transfer $2,000 a month into that bank account because that's what I know it's going to cost me to hold that property. Um, I find that if I set up all these automatic transfers, the money's gone. I'll never really miss what I never had because I don't really see it. The money comes into my account and then quickly goes over into those offset accounts. And that's what I mean, invest first and spend what's left over. Therefore, I know what's left in my account is really for living expenses and so forth, and I can safely go and spend that money. Number three, borrow more than you need to, which is really building a buffer in your loan account, which means it gives you ready funds to access in case of emergencies. Now, you've got to realise that interest rates are relatively high at the moment. Rental incomes are rising and so forth, but interest rates will eventually come down at some point. And at these interest rate levels, cash flow is very sensitive to those interest rate reductions. So for example, using the example that I gave you, a 1% reduction in interest rate will reduce the negative cash flow by about 25%. So instead of the property costing $2,000 a month after tax, it'll cost $1,500 after tax. So at some point over the next 1 to 2 years, interest rates have probably come down. Whether they come down by a full percent, it's entirely possible, but maybe it'll take longer to do that. I guess what I'm saying is that this is probably one of the most expensive times to invest in property. And so if you build in a buffer, and let's say over the next couple of years, you've got to dip into that buffer, that your cash flow isn't enough to be able to pay for all the holding costs. And let's say you use up $10,000 of your buffer over the next 2 years. You're actually better off to do that than waiting and delaying the investment for 1 to 2 years. Because obviously over that time, prices can rise and prices will almost certainly rise and you'll pay a lot more than $10,000 to buy the same quality asset in 1 to 2 years than what you'll have to pay today. So building in that cash flow buffer will give you that sense of comfort that, hey, look, I can afford to buy the property now. It's tight and it's really tight, but I can afford to do it. At least you know that if some unforeseen personal expenses arise, you've got a bit of a buffer to fall back on to help you fund the holding costs of your investment property, which leads me into the fourth tip, which is really stay long-term focused. Property investing is a long-term asset, it's a long-term investment. We know that rental incomes are rising and will continue to rise just because of supply demand. Employment incomes will rise over time, everything rises with inflation. What does not rise with inflation is your loan amount. And so in real terms, when you factor in inflation, your loan is actually reducing in real terms because that dollar value is fixed. And so the gap between the income and all the expenses associated with the property will gradually compress, become cheaper and easier to hold the investment property. The tough bit is getting into the market and getting started. Now, of course, always borrow safely. You've got to take some risk when investing. And when you take risk, you're natural to feel uncomfortable. Every investment property I've ever purchased, I thought, wow, that's a lot of money to spend. The holding costs are high. I hope it works out. And it always has, which is not have blind faith. Sit down and look at the numbers. Make sure you're really comfortable with the numbers. Make sure you can afford what you're planning to borrow, but realize that particularly at these interest rate settings, it's probably going to push your comfort zone a little bit, and that's just part of investing. So I hope that's been useful. If you want to learn more, subscribe to my YouTube channel or my podcasts. The link is in the description of the video underneath, and look forward to talking to you soon. Cheers.